Hello, how are you? Welcome back. Before I started this session, I told myself I have to find some other way of, welcoming you back. I keep saying for the last 8 or 9 videos, I keep saying welcome, hi, how are you? You're probably bored of that by now. So I'm going to work on that, and maybe by the next session, I'm going to have a better way to, welcome you back. All right, for now, you have this visual up on your screen, and you're probably wondering what is happening here. What is actually happening here is you probably heard this phrase which says cash is king, right? Cash is everything. Show me the money. Where is the money? Cash is king. So this is supposed to depict that, and hopefully it does a crown on top of a bunch of Gandhi notes, 500 rupee notes here. So essentially, a business consumes money. A business in many ways exists to make money, make cash. Without cash, there's no business. All your asset sheets and your balance sheets and your operating income and expenditure, all that revolves around cash, which is why cash is, people say cash is king, and the king gets, his own statement sheet called the cash flow statement, which is going to be the focus of our session today. Now, over the previous sessions, you've looked at what the income statement is and how the income statement explains the operations of a company. You've looked at what a balance sheet is and how a balance sheet explains the financial aspects of a company, the non-operational financial assets and liabilities of a company. And what the cash flow essentially does, it's somehow sits in between the balance sheet and the income statement, and somehow connects both these things, and I'll explain to you how that whole thing happens. Okay, so when you're a small company, let me go to our small simple income statement. All right, our simple income statement, right? So when you're a small company, just 2 people running the company, you're running around making a few pizzas and delivering it, you pretty much can get by with this thing. A very simple income sheet, you can get by with it. Now, as and when you add, you become big, you're scaling, you're adding more centers, your revenue is growing up, you're hiring more people, you might have to start having this one. Where's our balance sheet? You'll have to start having a simple balance sheet, because when you start scaling, you're going to have cash in the bank, you're probably going to invest some money in the stock market, you're probably going to take some loans and all of that. So as your company goes up, you're going to see the need of having a balance sheet as well. Not that you should not have a balance sheet from day one, but I'm saying in the initial days you can get by with just having a basic income street. Then you'll feel the need to have a balance sheet like this. And once you have this income sheet and balance sheet, you'll realize, after a few years of running your company, you probably have to become a public company, or you're going to raise professional investors' money. Then you're going to feel the need to have a cash flow statement. Again, it's great practice to have a cash flow statement from the day one of your company, but it's not going to break your bank if you don't have it. But you will realize the need for it as you, build the business up slowly. So so that is kind of the importance of a cash flow statement. It essentially tells you what happened to my money. It essentially tells you what happened to my cash, like how did I spend my money. That's what a cash flow statement, at a very fundamental level, that's what it tells you. And what we are going to do to understand this much better, we are going to take the Domino's cash balances, and we're going to see what work does a cash flow statement do in that entire larger scheme of things. All right, so I said a cash flow statement basically tells you what happened to my money, which basically means, let's say at one point of time your starting cash balance was whatever. There was a starting cash balance, and then there was the ending cash balance. Okay, you started with this amount of money, you ended with this amount of money. In between all this, let me write that down, right? What happened to my money? Okay, what happened to my money? That is a cash flow statement. All right, what happened to my money in between all this. A cash flow statement is going to tell you that. So let us go to the starting cash balance. Where are you going to find the cash balance for a company? Obviously the balance sheet. You go to the Domino's balance sheet, you go to the statement here saying the cash and bank balances, and let's say we go to the year 2008. 2008, Domino's had 2.1 crores in cash in the bank. You remember, this is in millions, so it's 21 millions. 10 million is a crore, so 21 million is 2.1 crores. So if on March 31st, if after the end of this financial year, if Domino's had 2.1 crores left, okay, that means if end of a financial year, if Domino's had 2.1 crores left, that means for the next financial year, the previous year's ending balance is going to be the starting balance for the next year, right? So the starting balance is 2.1 crores in cash, and we're going to write that down. 2.1 crores in cash. The ending cash balance is going to be this is your ending cash balance as of March 31, 2009. That is 3 crores, right? 3 crores is the ending cash balance. 3 crores. Now we got these two numbers from the balance sheet. What a cash flow statement is essentially whatever happens between these two numbers. That's a cash flow statement. So think about this. For a company like Domino's, or even think of a small company like your own private pizza business, what can happen to cash? Like, how did this 2 crores become 3 crores? How did you suddenly get 0.9 crores or 90 lakhs? What all could have happened, right? In between all this, just because money went from 2.1 crores to 3 crores, that doesn't mean your business just got cash inside. Cash also went outside, but net your balance went up by 90 lakhs. So look at Domino's balance sheet here and try to come up with ideas. What are the possible reasons cash was being used in this business? Used as in either inflow of cash or outflow of cash. Why was cash being used? Think of the various reasons. What is the first obvious reason you can think of where cash was used? Right? You remember the whole income statement. You see here the different places cash is being used. Cash is being used to make the pizza, the dough, the cheese, the olive oil, the vegetables, and all that stuff. So your cash is being used in cash is being used for the ingredients of the pizza. Let's make this small. What is the spelling of ingredients? I think sorry. I think that is the right spelling. I'm sorry if the spelling is wrong, but I'm pretty sure I suddenly have a problem with the spelling right here. But I'm pretty sure that's the right spelling. Okay, the ingredients. The ingredients is that. Oh yeah. So we don't actually. You know what? We don't have a I there. That's ingredients. Okay. All right. I need to get better at my spellings. Okay. You spend money on ingredients to make the pizza. What else are you spending money on right here? Look at this. You're spending money on rent, marketing, salaries, and all of those things. You're spending money on rent, salaries, marketing, and all of that, right? So this, if you had 2 crores, you're using money for this, buying ingredients, you're using some money for the rent, you're using some money for the salaries, you're also using some money for the marketing. It's not lesser than marketing, it's marketing, okay? Then, where else are you using money? Is that it? Now, it's true that that's all the income statement has, but is that all where the money is used in the company? Just think about it. Apart from the income statement, we also learned of something called the balance sheet, right? Apart from the operating activities of a company, the company has other things. The company, you're only thinking, if you said the company has to buy equipment, the company has to buy ovens, the company has to buy furniture, the company has to buy interior decorations and name boards and things like that. The income statement doesn't have any of those things, right? What has all of these things? The balance sheet. So we have all those expenses, right? We have to buy equipment, we have to buy furniture for the store, we have to make up the interiors. You see how none of these are here? So those are things you need the money for. Now that's a good point. Let us highlight each of these in a different color so it's kind of intuitive to us. Blue and pink, all right? Okay, and then is that it? Is that all a company uses its money for? Is that the entire inflow and outflow of money? You have money for your operating purposes. You have some money for buying your equipment. There is one more aspect, right? If you look at the balance sheet, you'll probably remember there is also an aspect where a company gets money not only through its operations, but a company gets money through loans. People lend the company money. That is not in your income statement. That's only in your balance sheet. So loans, a company gets money through loans. And then what happens? Because of that, a company has to pay interest. You remember this whole thing here? The interest expense is in the income statement, obviously. This whole income, the interest expense. So interest is it does nothing to do with making the pizza, running the pizza and all that, but it's got to do with servicing this loan you took. Let's give this another color here. Let us do this. All right. Okay. So there are all these different categories of expenses or inflows and outflows of cash for a company, and they're very popularly and you see they form very distinct, clear buckets. This is operating activities, otherwise called cash flow from operating activities. Yeah, cash flow from operating activities. All the stuff that is involved with making the pizza and selling the pizza. Then you look at this. This is all to do with the company is investing money in the future of the company by buying furniture and ovens and all those stuff. So this is nothing but cash flow from investing activities, right? The company is, all this stuff are useful for the company going down the next year, 2 years, 3 years from now. So the company has a bunch of cash flows from investing activities. And finally you see here, this is called cash flow from financing activities. All right. So essentially, taking a loan, is issuing shares, issuing dividends, things like that, which don't have anything to do with the operations of the company, nor do they have anything to do with investing in a company, but basically funding the company. So that's why it's called financing the company. So essentially a cash flow statement, we essentially build the structure to a cash flow statement right here. All right. Essentially what we have done is we have said the starting cash balance. From there, if you take into account all the money used in the operating activities and all the money used in the investing activities and all the money used in the financing activities, finally you have your ending cash balance. That is how a cash flow statement is built. In our next session, we are actually going to really take numbers and populate these things in here and actually build a cash flow statement. But this gives you an idea why a cash flow statement is used and what the basic structure of a cash flow statement is. Hopefully that is clear to you by now. Thank you very much for taking time to listen. I will see you soon at the next session. And like I said, I'll find a new way to welcome you. Okay, thank you. Bye.